All right, let's dive right into today's explainer. We're bypassing all the hype and jumping straight into this massive, highly secretive world that, quite frankly, quietly controls the brands we interact with every single day. I'm talking about private equity. Let's pull back the curtain and see how this incredibly powerful financial engine actually works. $7.2 trillion. Just let that sink in for a second. To put that into perspective, that is larger than the GDP of most countries on Earth. And by 2025, the global private equity market is projected to hit this staggering valuation. It's literally a fundamental force in modern finance, channeling just astronomical amounts of capital into private businesses. But, despite its sheer size, the exact mechanics of how it operates remain a total mystery to most people outside the industry. So if you mention private equity at a dinner party, assuming you go to some pretty nerdy dinner parties, you'll usually get one of two extreme reactions. Are they these ruthless deal makers just stripping companies for parts? Or are they pension fund saviors, quietly earning market-beating returns for teachers and firefighters? Well, both pictures have some truths to them, but today we're skipping the emotional debate. Instead, we're going to look completely objectively at the actual mechanics driving this entire industry.
Part 1. Who are the key players? To understand this trillion-dollar ecosystem, we first really need to identify the two critical players who make every single transaction happen.
First up, we've got the general partners, or GPs. These are the alphas, right? The hands-on deal makers and strategy architects running the whole operation. They're out there sourcing the deals, conducting some incredibly intense due diligence, and ultimately taking the driver's seat to aggressively improve the companies they buy. They take on a liability and, in return, earn their compensation through management fees and a huge share of the profits, which the industry calls carried interest.
Then, on the flip side, we have the limited partners, the LPs. Think of your massive institutional investors, pension funds, university endowments, insurance companies. Honestly, your own retirement money might be sitting right here. They provide the massive pools of capital, but they remain completely passive when it comes to decision-making. They just hand over the money, trust the GP's expertise, and limit their financial exposure strictly to what they've already committed.
And this dynamic creates a fascinating trade-off that totally flips the traditional stock market model on its head. Think about it. If you buy a public stock, you have high liquidity. You can sell it any day of the week, but you only get public info and absolutely zero control over the company. Private equity completely sacrifices that short-term liquidity, literally locking up capital for up to 10 years. But instead, they get deep behind-the-scenes informational access and active hands-on control over a company's destiny.
Moving on to part 2, the private equity playbook. So how does one of these massive funds actually operate from start to finish?
A standard private equity fund operates on a very rigid, highly structured timeline. First is the investment period. This spans about 3 to 6 years, where GPs are just hunting for and closing deals. During this time, they officially call the pledged capital from those LPs. Next up is the value creation phase. This is where the GP's team really rolls up their sleeves, working directly with management to cut costs, expand into new markets, upgrade tech, the whole shebang. And finally, the exit or harvesting phase, where they sell the company off, maybe to a strategic buyer, or maybe taking it public via an IPO, all to return those sweet profits back to their investors. Which brings us to part 3, the mechanics of value creation. Let's look at the most fascinating part of all this. How do these firms actually engineer outsized returns from a totally standard business? The absolute classic engine running this industry is the leveraged buyout, or LBO. Imagine taking out a giant mortgage to buy a house. Actually, it's exactly like that, just on a massive corporate scale. A firm buys a mature, cash-generating company using a tiny sliver of its own money and pairs it with a massive, massive amount of borrowed debt. And here is the absolute genius, and for sure the biggest risk, of the whole model: debt gearing. The private equity firm uses the acquired company's own operating cash flow to pay down that massive principal debt over time. By doing this, they mathematically amplify their own return on investment. Even if the overall value of the company doesn't grow all that much while they own it, simply paying down that debt increases the private equity firm's slice of the pie. It's a wildly effective strategy. Now, modern private equity goes way beyond just loading up a company with debt. They use this framework known as the 4A's to engineer legitimately better, more efficient businesses. We've got amplification through that financial leverage we just talked about. Alignment, meaning they tie executive incentives directly to capital gains instead of just handing out big base salaries. Active management, where GPs take real operational control and board seats to force change. And attention to detail, executing incredibly rigorous due diligence on every single aspect of the business, from complex tax structures all the way down to the supply chain.
But okay, let's be real, all this leverage comes with a terrifying bankruptcy risk. Experts call it the equity illusion. If a company's debt burden, specifically the interest it owes to banks, starts growing faster than its actual operating profits, the value of the company is basically hollowed out from the inside. The executives might hold a high percentage of shares on paper, but the actual value gets completely eroded by those mounting debt claims. It's a total high-wire act, especially when interest rates spike.
So part 4, risks, returns, and the future. This brings us to the ultimate scorecard. After all the crazy fees and decade-long lockups, do these intense strategies actually beat the standard public stock market? Looking at the hard historical data, it paints a very, very clear picture. Over both 10 and 20-year horizons, private equity buyouts have historically outperformed public indexes like the S&P 500. And honestly, it's this exact track record that keeps the massive institutional capital flowing in, year after year after year. To put a specific number on it, extensive research from some of the biggest asset managers shows these funds deliver a really impressive 3 to 4 percentage point premium annually over public equities. And here's the craziest part. That outperformance is calculated after taking out all those complex management fees and carried interest. It's a very real, very measurable premium. But the landscape is shifting right beneath our feet. With interest rates staying high, that classic cheap debt playbook that fueled so much of those past returns, it's basically dead. So we have to leave you with this question. How on earth will this industry evolve to hit its massive $21.7 trillion projection by 2035, when basic financial engineering just isn't enough anymore? True operational mastery is going to become the only way to survive. The trillion-dollar playbook is transforming right before our eyes, and you'll absolutely want to keep watching this space.